My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. As the late baseball great Yogi Berra famously once said about a red-hot restaurant, nobody goes there anymore. It's too crowded. That's exactly how I feel about the Magnificent Seven, a red-hot group of stocks that are equally crowded. Yet nobody seems to own them anymore. Even on a solid day where the Dow ultimately gained 84 points, S&P edged up 0.1%, Nasdaq advanced 0.29%. So much of the market is about these stocks, 6 of which we've owned for the Travel Trust for some time, which you can follow by joining the CNBC Investing Club. The weightings of Alphabet, Amazon, Apple, Meta Platforms, Microsoft, NVIDIA, and Tesla, when added up, are equal to 29% of the S&P 500. So why shouldn't the index swing with them? Let's go back to Yogi Berra's observation. You have to wonder why so few people actually seem to own any of these stocks. I spend a huge amount of time speaking to investors, probably more than almost anybody on earth, especially young investors. Where I go, rarely do I ever hear anyone who actually owns these stocks. In fact, unless I have a bottle signing for my wife's premium mezcal brand, I don't even meet people who own NVIDIA, despite the fact that I named my rescue mud after the semiconductor giant. Why is that? Well, there are a bunch of reasons. We got to go over. First, let's take the Magnificent Seven as a group. Most of these stocks have high dollar amount prices. Of course, in theory, that shouldn't mean a thing. Just buy one share, a fractional share, even through your broker. But most investors simply aren't willing to do that. They want to buy stocks, and they want to buy stocks under $100. They want it to be like it was in the 1980s, 90s even, when every time a stock went into triple digits, the company would do a 2 or 3 for one split. That way, individuals could buy 10 shares. And that's what people like, real people. But these days, most companies don't either, maybe they don't understand your mindset, or they're catering to the big institutions that prefer high dollar amount stocks because they pay their commission fees on a per share basis. 3-for-1 split, 3 times the commission dollars. Home gamers are sacrificed on the altar of the big money managers. Hey, but you know what they would say? They'd say, we run money for a lot of smaller investors, so it evens out. Unfortunately, even though it's irrational, those high dollar amount prices make it far less likely that individuals, that you, will actually buy any of these stocks. I guess you could say they're too high, so nobody goes there anymore. But beyond the big price tag issue, there are individual reasons why it's so difficult to own each name of the Magnificent Seven. See, there's a vast echo chamber of analysts and media that combine to frighten a huge number of you out of these stocks, no matter what. The amazing companies that I'm talking about here have people trying to scare you out of them every day, from Wall Street to your media. I'm now going to give you the top objections that I hear bears spread endlessly about these stocks, and then I'm going to shoot them down right on the spot. Let's start with Amazon. The bears focus on the fact that Amazon Web Services can't seem to grow as fast as it used to. I say that's simply the law of large numbers. Plus, they just announced a gigantic strategic collaboration with NVIDIA for new supercomputing infrastructure and software. Amazon wouldn't make that kind of investment if they were really worried about a slowdown at AWS. How about Alphabet? Almost everything was perfect about that last quarter except for Google Cloud. The cloud division did $8.4 billion in sales. Wall Street was looking for $8.6 billion. Its operating income came at $266 million. Wall Street was looking for $60 million more. Yep, Google Cloud missed by $60 million, and in response, Alphabet lost almost $180 billion in market capitalization. That's right. It went from $1.76 trillion to $1.58 trillion. That's insane. But all we heard from the analyst media complex was Google's cloud business is being crushed, either because of slowing cloud services, bad for everyone, or lost market share, bad for Alphabet. Not only is that a ridiculous overreaction, but if Google Cloud reaccelerates, let me tell you something. This one could put on $180 billion right back, immediate. In fact, it nearly has already, with Alphabet's market cap back to $1.73 trillion at this point. Next, the knock on Apple. It has to do with analysts harping on an alleged slowdown of iPhone sales worldwide as measured by shorter wait times. I say, who the heck really knows what the number is? More important, you need to measure the lifetime value of a new Apple customer by looking at what they're likely to spend on various services and subscriptions and products. When you look at the company like that, you know it's way too cheap, as that service revenue just won't quit. Lifetime value of a user. How about Meta Platforms? This stock's being kept back by what the analysts see as Mark Zuckerberg's almost, let's just say, Moby Dick-like cult-like obsession with the metaverse. I say, wait a second, the rest of the company is extremely undervalued, and this stock doesn't even, you don't even get the value of WhatsApp. It's worth nothing. As for the metaverse, I know it's hard to believe, but do you really think that Zuckerberg suddenly has no idea what he's doing? Didn't he pivot from desktop to mobile? Didn't he move from Facebook to Instagram? Didn't he start Reels to compete with TikTok and make it work more quickly than anyone expected? I think he's earned the benefit of the doubt. He doesn't like losing money, for heaven's sake. Microsoft quizzically has no bear case. There you go. It's been clear sailing for these guys. That's right. The only thing I hear is that the stock has moved up too far too quick. But there are no speeding tickets in this racket. Their Copilot AI product is crushing it. Stay long. The rap against NVIDIA is that its products are too expensive, so expensive that the company's losing huge customers to AMD, its competitor, or to internally developed competition. I say the customers wish they could use something other than NVIDIA. The fact is, this is one of the situations where NVIDIA is truly a benign monopolist because its product is far better than anyone else's. Hey, go ask the Chinese. NVIDIA stock always seems expensive, but when you look back, it was cheap in retrospect. 12 months ago, Wall Street thought NVIDIA could earn $4 a share. Now it looks like they're going to do 12. Plus, can you really just judge this company as a hardware play when it's got so much embedded software these days? If you analyze NVIDIA as an AI stock rather than a simple chip maker, this one will be receiving a much higher multiple than that $12 number, not to mention next year's $20 earnings estimate. Is it cheap? No. Is it value? Well, versus the others in the Magnificent Seven, yes. Tesla stock's been slammed because when the company reported, Elon Musk said interest rates on new car loans were too prohibitive and it's going to hurt sales. Tesla reported at the height of the run in interest rates. Since then, loan rates have pulled back dramatically. So that excuse holds much less water. Despite these rebuttals, I think their success in 2023 made each of these stocks into their own worst enemy. For instance, look, we had to do some trimming of Meta and Alphabet for the Charitable Trust simply because you have to trim gigantic winners or they're going to dwarf the rest of your portfolio. That was what was happening to us. Bottom line, I wish I could get these companies to split their shares in favor of you, the home gamer. And I wish the bearish analysts didn't try to justify themselves every single day and the media could just occasionally write something positive to go with the myriad negatives that they constantly harp on. But then again, if everyone went there, who knows whether they'd still be too crowded or if they could still go up. Let's go to Robert in New York, please. Robert.
Hey, Jim, I have to say, you make us money. When everyone was about to sell, you calmed the waters. If you were steering the Titanic, they would have never hit that iceberg. So steer us in the right direction on a stock that has a great balance sheet, Airbnb.
All right, first of all, your comments are most needed, and I welcome them, and it's terrific. Come back from vacation and hear these kinds of things. I am thrilled. Second, Airbnb is a stock that I like very much, and I think you can go not higher, but much higher, because Brian Chesky is a great operator, and they almost entirely own this segment. Airbnb, it's good enough for me, and thank you for those kind words. Bob in Missouri. Bob.
Jim, booyah, Jim, I want to thank you for all the hard work you and your staff put in for us,
Thank you.
guys.
Staff is amazing. We work close together every day, and you cannot believe how good they make me look. How can I help you?
I want to thank you. I'd like to know your thoughts on Hershey, Jim.
Okay, Hershey just got downgraded later this evening, and I was surprised. Now, it is a stock that people feel is in this, right in the crosshairs of these GLP-1, the weight reduction drugs. I have to tell you, I think that Hershey's been punished enough. I would actually start a position right here. It's very well run, but I buy it gingerly and not aggressively. Let's go to Austin in Arkansas. Austin.
Booyah, Jim.
Booyah, Austin. What's going on?
Well, I got a question for you about Take-Two Interactive.
Mm-hmm.
Couple months ago, I got on kind of seeing the hype around GTA 6, and I bought in. And currently, I'm up about 28%. And I was wondering if I should keep riding that hype train or go ahead and cash out.
I'm going to give you a third option. I think you should buy more. I think that Strauss Zelnick, this is his time. I think Take-Two at 156 represent great value. Why? Because GTA, new volume is coming out. I want you in the stock. I want you to buy more. All right, now, look, before we wrap up here, I think it's important that you know this. I know everyone watching loves investing. And so I want to take a moment to mention that today we lost one of the truly great investors of our time. His name was Charlie Munger, who, of course, was Warren Buffett's right hand for so many years. Our own Becky Quick has brought us many thoughtful interviews with Charlie, and countless investors have learned from his amazing instincts. He will be missed. On Mad Money tonight, we're continuing our series on stocks that might suddenly work again if interest rates have peaked. This time we're drilling into the pipeline plays. I'm sharing which names I like the most. Then just talk about how the bears feel about Tesla. But what are the technicals saying about Tesla? I'm going off the charts with double the Fibonacci Queen to see where the stock could be headed. And like us, this market is laser focused on rates. So could now be the time for a cyclical player like Dow, the gigantic chemical company? I'm getting the latest from the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.